This is perhaps the most important lesson in the course because it really gets at how audits are tailored for different circumstances. Today, we're going to tackle audit risk. And audit risk is quite simply the risk that the auditor gets it wrong. But what does a wrong opinion really mean? Well, first of all, we need to recognize that an audit provides reasonable assurance, not absolute assurance or a guarantee. Secondly, the opinion states that the financial statements are free of material misstatement. Not all misstatements, just material ones. With this understanding in mind, it's entirely possible that the auditor gets their opinion wrong when there is in fact one or more material misstatements contained within the financial statements that were not detected during the course of the audit. Users commonly misinterpret what an audit opinion really represents. And as a result, when a company fails, it's common for the auditors to get dragged into the ensuing litigation as stakeholders scramble to recover as much of their investment as possible from anyone remotely involved with the information they relied upon. Now, audits are fraught with uncertainty, which gives rise to risk. How auditors deal with risk is of the utmost importance. As we have mentioned in previous lessons, audit work is directed on the areas that pose the greatest risks. The audit risk model is generally accepted as the conceptual model for assessing risk, evaluating it, and ultimately reducing it through the gathering of audit evidence. The audit risk model is represented by the equation audit risk equals inherent risk times control risk times plan detection risk. Let's spend a few minutes discussing the components of this model, and then we'll play with some scenarios so that you can see the model in action. Audit risk can be thought of in terms of acceptable tolerance for screwing up. As we have discussed in previous lessons, it's not practical to totally eliminate audit risk. And to do so requires the auditor to look at every single shred of evidence possible. The audit would never get done on a timely basis, and the cost would be prohibitive for the companies. Obviously, auditors don't want to get opinions wrong all that often, so the public accounting firms strive to minimize this risk to the extent possible, trading off cost-benefit considerations. For many firms, the quantified tolerance of audit risk is 5% or lower. Audit assurance is the complement of audit risk. That is 1 minus audit risk. It's another way of describing the other side of the same coin. So if our audit risk is 5%, our audit assurance is therefore 95%. Thus, an auditor can say that they are 95% confident that they've issued the right audit opinion. Now, generally speaking, the more risky the engagement, the lower the level of audit risk the auditors are willing to take on. Why is that? Well, simply because the risky engagement, for example, one where a company has a high likelihood of failure, exposes the auditor to greater threats of litigation. The key areas to consider in assessing engagement risk are the degree to which the external users will rely on the financial statements. The greater the reliance, the greater the engagement risk. The likelihood of financial difficulties for the client. In other words, the weaker the client's financial strength, the greater the engagement risk. And management's integrity. The less integrity, the higher the engagement risk. So in a highly risky engagement, the auditors may try to minimize audit risk to only 1 or 2% instead of 5%. At least conceptually, that's how they ensure that they cover their ass. I say conceptually because while I throw percentages around, which seems very precise, auditing is not that precise in reality. Normally, auditors will talk about risk in terms of low, medium, or high. Auditing is laced with professional judgment, as we've discussed. And by the end of this lesson, you'll understand better what I mean. But for now, let's just pretend that the audit risk model is a true mathematical equation. Let's move to the other side of the equation sign and define the other elements of the model. First, we have inherent risk. And inherent risk is the likelihood that a material misstatement might occur in the first place, assuming no internal controls exist. Next, we have control risk. And control risk is the likelihood that the client's system of internal controls will not prevent or detect a material misstatement. And finally, we have the plan detection risk, or simply detection risk. And detection risk is the risk that our audit procedures will fail to detect a material misstatement. Let's look at the audit risk model in terms of a picture to help you visualize this conceptual model. Inherent risk is represented by all those little drops of rain that you see marked as errors falling from the sky. The harder it rains, the more likely we are to get wet. Inherent risk is rain. In some businesses, like say a rental property, inherent risk is minimal because the business is dirt simple. However, in other businesses, say an insurance business, it's a monsoon because of the complexity and the judgments implicit in the business model. That stuff is inherent risk. Think of the strength of the client's internal controls as an umbrella, designed to shield the financial statements from the rain. If the umbrella has holes, then the rain gets through, at which point it all comes down to a choice of raincoat that the auditors put on to keep dry. If the auditors feel that there is risk of a torrential rain and the umbrella is of little protection, they may choose a survival suit, which in audit terms means that they will take all precautions necessary to stay dry. On the other hand, if the rain is more of a mist and the umbrella is more like one of those giant golf umbrellas, then the auditors can probably get away with the simple windbreaker and still be adequately covered. Now let's work through the mechanics of how the model works using a more literal description of each of the four components. To begin with, audit risk is set during the client acceptance and continuance stage. For our purposes, let's assume that we want to minimize our audit risk to 5% and that this is a normal risk engagement. Now, as we move to the right-hand side of the equation, there are certain elements that we assess, and there are others that we have more direct control over. Inherent risk is one of those elements we assess through our conversations with management and our knowledge of the client's business. Think of a high-risk assessment as a high percentage. Say 100% chance that a material misstatement could occur. A low-risk assessment might be, say, 50%. Or said another way, a 50% chance that the material misstatement might occur. We plug this percentage into the model and move on to the next element. Control risk is an element that we also assess based on our understanding of the client's internal controls, as well as our own evaluation of the design and operating effectiveness. So a client with a weak internal control system may not be able to prevent or detect a material misstatement from happening, in which case we may assess control risk at maximum, or in numeric terms, 100%. In other circumstances, we might determine that the internal controls can be relied upon to prevent or detect a material misstatement, in which case we could assess control risk at less than maximum, say 50% for argument's sake. Note that any time that we say control risk is less than 100%, we're going to have to gather evidence to support that assessment by testing controls. Thus, we can now plug this percentage into the audit risk model as well. We can now solve for our planned detection risk. And in the case where we had a high inherent risk and a high control risk, both values at 100%, you can see that the detection risk would have to be reduced to 5% to minimize our overall audit risk to our desired 5% target and make this equation work. In the case where we assess both inherent and control risk as low, in other words, at a value of say 50%, you could do the algebra to determine that the detection risk would have to be 20% in order to now make the equation work. Detection risk represents the amount of substantive audit work we perform. Said another way, we gather audit evidence to support the management assertions to reduce this risk. The more evidence we gather, the lower the risk that we miss anything. So the way you can interpret our two cases is that in the situation where we had assessed inherent and control risk as high, we need to gather a lot more evidence than in the case where we assess these same risks as low. At least anecdotally, you could conceptually think of it as 4 times more evidence. However, audits don't tend to work in a neat, linear fashion in that way. The audit risk model can be applied on a global basis. That is for the whole of the client's company to define the global audit strategy. However, it's much more practical to apply the audit risk model on an account-by-account or assertion-by-assertion basis. And yes, that's a lot of assessments you need to make, but most audit planning programs will walk you through the consider points to help you make this determination expeditiously. And one last point before we close off this lesson. Let's say that during the course of the audit, new information has become known that contradicts our assessments of inherent risk and control risk. If this happens, the auditor must return to the audit risk model and recalculate detection risk accordingly. And this will manifest itself by requiring additional audit procedures or larger sample sizes as necessary so that we can achieve our desired level of audit risk. So the audit risk model is just not something that we consider once during the planning phase. The audit risk model is updated throughout the course of the audit. And so that's all for this lesson. So until next time, don't stop till you get to the top. When you get to the top, don't stop.